Hello and welcome to the lesson. We are going to start on a new topic, accounting for assets and liabilities. The first subtopic is property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment is the first subtopic. So the first subtopic is property, plant, and equipment. We have intangible assets, financial assets and liabilities, inventory. We have cash in hand and cash at bank, trade receivables, trade payables, accrued incomes. So property, plant, and equipment, the first subtopic. And candidates, property, plant, and equipment, the PPE, is also referred to as fixed assets. Property, plant, and equipment are also known as fixed assets and are tangible assets that an entity holds for use in the production or delivery of goods or services. Or an entity may be holding these assets for rental to others and that are expected to be used for more than one period. So fixed assets, property, plant, and equipment are assets that are expected to extend for more than one accounting period. These are tangible assets that you can see with your eyes, you can touch with your hands, like buildings, like this building, like the land, equipment, furniture, motor vehicles, machinery, plant. All those are examples of property, plant, and equipment, computers, and so on. Do you understand? That's the meaning of property, plant, and equipment. At this level, we are required to learn how to account for PPE. And candidates, accounting for PPE involves what we call initial recognition, accounting. I've defined PPE, accounting for PPE. Now, in accounting for PPE, involves one, initial recognition. Initial recognition. PPE is recognized at its cost. It is initially recognized in the books at its cost. If you buy land worth 10 million, that's the cost of the land, the initial cost of the land, which includes the purchase price, which includes the purchase price, that is the price of the land, the transportation cost. If you are buying, for example, a motor vehicle from Basa or from wherever, you may incur some transportation cost. So that transportation cost becomes part of the cost of the PPE. You understand? There are some assets that may require to be installed. So any installation cost of such assets like plant, equipment may be required to be installed. The amount that is incurred in installing such assets forms also part of the cost of the asset. So initially, PPE is recognized at cost, which includes the purchase price, transportation costs, installation costs, and any other costs necessary to get the asset ready for use. And any other asset or cost necessary to get the asset in use. So all these costs are capitalized. All these costs form part of the cost of the PPE. So that is how PPE is first recognized or accounted for. Then there is subsequent measurement. Subsequent measurement. Subsequent measurement means after this asset has been initially recognized in the books at the cost, for example, the first accounting period, assuming the accounting period begins on, say, January 1st, then ends on 31st December. So the asset is bought on January 1st, and it is accounted for that way in the books of the company. Then subsequently, how do we account for PPE? Subsequently, in the subsequent accounting period, how do we account for PPE? That's what we are referring to as subsequent measurement. Now, PPE is generally measured at its cost less depreciation. Subsequently, PPE is measured at cost less depreciation. It's measured at cost less depreciation. Subsequently, PPE is measured at cost less depreciation and any other impairment losses. Do you understand? Depreciation. So that brings us to the question of depreciation. Depreciation. Now, depreciation is the loss in value of an asset as a result of use. As the asset is used, it depreciates. You understand that, candidates? If you have an asset and you are using it, the asset wears out. And that wearing out is what we are referring to as depreciation. So the cost of PPE is allocated over its useful life through depreciation. And there are various methods that we use to value depreciation. Depreciation is the systematic allocation of the cost of a tangible asset over its useful life. And it reflects the wear and tear, it reflects the obsolescence, and also the economic decline of an asset over time. That's the meaning of depreciation. And there are many methods that we use to calculate depreciation, to allocate depreciation. So the common methods are common methods of valuing depreciation. Number one is a straight line method. Number two is the reducing balance method. or declining balance, reducing balance method. So there are many other methods, but we will only discuss the two. Straight line method is one common method that we use to determine depreciation of fixed assets. Now, straight line method allocates the same amount of depreciation expense to each period throughout the asset's useful life. That is the straight line method. Under the straight line method, the depreciation is uniform year in, year out throughout the useful life of the asset. You understand? It is uniform. It is the same. The method allocates the same amount of depreciation expense to each period throughout the life of the asset. And the formula is, we take the historical cost, we deduct the salvage value or the scrap value or the residual value, we divide it by the economic life of the asset or number of years. That gives you the depreciation per annum. Then it is spread out through the economic life of the asset. Is that clear up to that point? Let's have an illustration. Kizito Enterprises has a financial year ending 31st December. The machine was bought for 2 million on 1st January 2020. Kizito intended to use the machine for 4 years. It was to be depreciated using the straight line method. Required. The records for the depreciation of the machine for the 4 years showing 1. Depreciation for every year. 2. Provision for depreciation account. 3. Profit and loss extracts. 4. Balance sheet extracts. So let me just have the illustration here. Let me have the illustration on page 3 of my board. Illustration. Requirement 1, depreciation for every year. We are using the straight line method. Straight line method. We've seen depreciation per year using the straight line method is uniform, and we take the cost of the asset, we deduct the salvage value or scrap value, we divide by the number of years or the economic life. So what is the cost of this machine? It's 2 million. Does it have a salvage value? No. So the cost is 2 million minus 0. We divide by the economic life of 4 years. 4 years. What is the depreciation per annum? George, 2 million divided by 4. Is it 500,000? Is it 500,000? Yes. So that is the depreciation for every year. So every year, that will be the depreciation charge. Depreciation for the year, depreciation for each year is 500,000. This is Roman 1.